Considered by many to be one of the greatest investors in history, Warren Buffett has amassed his fortune by a timeless and methodical approach to investing. His strategy places a strong emphasis on long-term planning, wise investments, and a thorough comprehension of business principles. In this video, we will go through 7 key points that define his investment philosophy and can guide anyone toward financial success. Number 7. Invest for the long haul. The idea of long-term thinking is fundamental to Warren Buffett's investing strategy. He is adamant that money is not created in months or years, but rather over decades. His well-known remark, "Our ideal holding period is forever," perfectly captures this concept and his goal of holding on to high-quality investments eternally. By embracing this way of thinking, Buffett lets compound interest do its job and gradually transform modest assets into significant fortunes. Additionally, this technique reduces taxes and transaction fees that come with frequent buying and selling, which can severely reduce returns. Additionally, Buffett counsels investors to adopt the mindset of entrepreneurs and prioritize the company's long-term success over transient price swings. This viewpoint assists investors in concentrating on the core principles of the company rather than making rash selections based on market volatility. Buffett, for example, takes into account a company's market position, brand strength, and potential for long-term growth in addition to its present stock price when making investments in companies like Coca-Cola. Buffett has done this to show that perseverance and patience are essential for long-term financial success. Because of his long-term strategy and faith in the inherent worth of his investments, he is also able to weather market downturns. His careful examination of each company's finances, management, and competitive advantages gives him this confidence and guarantees that his investments are positioned for long-term success. Number 6. Focus on quality companies. Buffett's investment philosophy places a strong emphasis on identifying and investing in high-quality businesses. He seeks companies with robust fundamentals such as consistent earnings growth, high return on equity, and low debt levels. Additionally, he looks for businesses with a durable competitive advantage or economic moat, which protects them from competitors and ensures long-term profitability. By focusing on quality companies, Buffett minimizes risks and ensures that his investments are resilient during economic downturns. He also prefers companies with strong management teams, as they are crucial in navigating challenges and capitalizing on opportunities. Buffett's focus on quality is not just about financial metrics. It also involves understanding the company's culture, its position in the market, and its potential for sustainable growth. This comprehensive approach allows him to make informed decisions and build a portfolio of businesses that can thrive over the long term. Number 5. Understand the business. One of Buffett's most important principles is to only invest in businesses that you fully understand what he calls staying within your circle of competence. For instance, Buffett has famously avoided investing in technology companies for much of his career. By sticking to businesses he understands, Buffett reduces uncertainty and makes more informed decisions. Buffett's approach encourages investors to be honest about their limitations and to avoid venturing into areas where they lack expertise. For example, Buffett's understanding of the insurance industry allowed him to capitalize on opportunities at GEICO and other insurance companies, where he could leverage his knowledge to make informed investment decisions. Number 4. Look for undervalued companies. Buffett is a master of value investing, a strategy pioneered by his mentor, Benjamin Graham. He seeks companies trading at prices below their intrinsic value, essentially buying a dollar for 50 cents. To determine intrinsic value, Buffett analyzes factors like a company's future cash flows, earnings potential, and assets. He also emphasizes the importance of a margin of safety. Buffett's value investing approach requires patience and discipline, as it involves waiting for the right moment to invest. He is not afraid to hold cash and wait for opportunities to arise, rather than investing in overvalued companies just to be in the market. Number 3, be patient. Patience is one of Warren Buffett's greatest virtues as an investor. He understands that building wealth takes time and avoids chasing quick profits or reacting emotionally to market volatility. Instead of trying to time the market, Buffett focuses on finding great companies and holding them through thick and thin. His famous quote, "Be fearful when others are greedy and greedy when others are fearful," underscores his belief in contrarian investing and the importance of staying calm during turbulent times. Buffett's patience also extends to waiting for the right opportunities to invest. This approach allows him to maintain a disciplined investment strategy, unaffected by short-term market fluctuations. By combining patience with a deep understanding of business fundamentals, Buffett has consistently outperformed the market over the long term. Number 2, limit leverage and risk. Buffett strongly opposes excessive leverage borrowing money to invest because it amplifies risks and can lead to devastating losses during market downturns. Similarly, Buffett avoids speculative investments or high-risk ventures that could erode his capital base. Instead, he maintains a cash reserve to take advantage of opportunities when they arise while protecting himself from unforeseen events. This conservative approach to risk management is a hallmark of Buffett's strategy. For instance, during the 2008 financial crisis, Buffett's cash reserves allowed him to invest in distressed companies at favorable terms, while many other investors were forced to sell assets at depressed prices due to leverage. By prioritizing financial stability and avoiding excessive risk, Buffett has built a portfolio that can thrive in various market conditions. Number 1, retain earnings and repurchase shares. Buffett values companies that reinvest retained earnings into growth initiatives or repurchase shares when they are undervalued, develop new products, or acquire other companies, all of which contribute to long-term shareholder value. Buffett has used this strategy effectively at Berkshire Hathaway by reinvesting profits into high-return opportunities rather than paying dividends. He believes that companies should prioritize investments that generate higher returns than the cost of capital. By focusing on retained earnings and strategic share repurchases, Buffett promotes a culture of long-term value creation, as it allows the company to compound wealth over time and reward shareholders with consistent returns. For example, when Berkshire Hathaway repurchases its shares at undervalued prices, this strategy reflects Buffett's commitment to maximizing shareholder value through disciplined capital management. By following these principles, investors can emulate Buffett's disciplined approach to wealth creation while avoiding common pitfalls like speculation and impulsive trading decisions. If you liked our video, please hit the like button and subscribe to our YouTube channel.